All right. The first full trading week of 2026 is kicking off, and the institutional intelligence you shared with us is, well, it's screaming instability.
Yeah.
Our mission today is to really go deep on that, connect the dots between this macro geopolitical shock and the very precise technical levels we all need to be watching before that 9:30 a.m. bell.
It is absolutely a high alert start. And it's hiding behind, seemingly benign numbers.
Right.
S&P 500 futures are nudging up, plus 0.25%, with the Nasdaq futures trying to lead at plus 0.55%.
On the surface, that looks fine, almost boring.
Exactly. It looks like a neutral continuation of that late December momentum, but that's the facade. The market is coiled, it's waiting for confirmation, and the tension underneath is just immense.
And I want to emphasize the sheer size of the catalyst we're digesting this morning. We're not talking about a Fed rumor.
No.
We're talking about a massive, kinetic geopolitical event that completely defined the weekend. We have confirmation of the removal of Venezuelan President Maduro by U.S. forces.
The institutional reaction to that was instantaneous. Even if the price action looks mild right now, that move triggered a massive uncertainty premium. It drove capital straight into classic safe havens. We're seeing a pretty significant surge in gold and silver, just pricing in that volatility and the immediate threat to global supply chains.
And that's really where the tension is for you, the listeners. You're watching the screen this morning. The market is bracing. It's caught between this huge shock to global energy and, well, tech trying to desperately cling to its valuation momentum.
Yeah.
So our sources are asking, is this quiet pre-market action the silence before a January storm, a violent rotation? Or is this the ultimate buy-the-dip opportunity for aggressive capital?
The answer is probably found in the dual headwinds that are already hammering the market, especially high-flying tech, well before the open.
Okay, let's unpack this because this is the core risk today.
Yeah.
Despite the NQ's slight pre-market lead, the macro forces rates and the dollar are putting immediate painful pressure on the valuation of every single growth stock. Where does this headache start?
It starts with the 10-year Treasury yield. It is hovering stubbornly near 4.3%.
Right.
Now, a lot of people in the retail camp are still positioned for this aggressive rate cut scenario this year, which assumes the 10Y has nowhere to go but down.
That assumption is getting tested hard this morning.
Very hard. And if that assumption fails, if the 10Y pushes higher today, specifically if it breaches that 4.20% floor we've watched so closely, that changes everything for stocks like the Magnificent Seven.
What does that actually mean mechanistically?
It creates a severe, an immediate headwind for duration. And when we say duration in this context, we're basically talking about how far out in the future a company's big profits are expected to arrive.
Got it. So high growth tech, the NQ darlings, they've got very long duration.
Exactly. Their big projected earnings are years away. So when yields rise, the present value of those far-off earnings gets aggressively discounted or, compressed. Crushed is a better word. That's why a yield spike is poison for tech valuations.
It's a direct financial mechanism.
Yeah.
Higher risk-free rate equals a lower theoretical stock price. But it's not just yields. Compounding this pressure is the dollar index, the DXY. It's at 98.63, up 0.21%, and hitting two-week high.
And that dollar strength is driven entirely by the safe haven bid tied to the geopolitical risk in Venezuela. When you have a domestic military action creating this much uncertainty in global commodity flows, capital flees that perceived risk, and it lands right in the greenback.
But the irony is that for big tech, the dollar strength is its own source of risk. It's a double whammy.
It is poison for their earnings. A stronger dollar eats directly into the international margins of the Magnificent Seven. Think about Apple selling an iPhone in Europe. When those euros are converted back into a strong US dollar, the revenue is just worth less.
That's not a small effect.
No. One of the reports you shared points out that a sustained 1% rise in the DXY historically shaves nearly 50 basis points off projected quarterly revenue for the biggest international tech players.
So if you're holding massive exposure to names like Microsoft or Alphabet that rely so heavily on those international sales, you're taking a punishing double hit.
That's right.
Higher rates, discounting future profits, and a stronger dollar reducing the value of your overseas revenue right now. This sounds like the perfect setup for that dreaded pain trade.
It is the setup for the pain trade that retail positioning seems to be completely ignoring. Our sources say retail sentiment is still heavily positioned, 63% bullish, largely betting on a swift, tidy, Goldilocks soft landing,
Which requires falling rates.
which absolutely requires falling rates.
So what's the actual mechanism of that pain trade? Let's say the 10-year spikes violently after the ISM data. What happens institutionally?
It's a brutal forced liquidation. Let's focus on the 4.5% level for the 10-year yield. Why that number? Our sources indicate that for many of the large risk parity funds, those massive institutional players that balance risk across stocks, bonds, and commodities, algorithmically, 4.5% is the trigger. It's predetermined.
So it's not a human decision.
Not at all. The model forces them to liquidate their most volatile assets, which means dumping high multiple tech exposure.
This isn't just a dip where people get scared and sell. This is an algorithmic mandate that triggers a deep, brutal sector rotation. Money flows out of the NQ and directly into the boring low-duration sectors.
Exactly. Energy, industrials, utilities, the stuff that offers stable cash flow now. The liquidity trap is set, the market is coiling, and the fuse is that 10.00 AM ISM data release.
So we get the pressure tech is under, but money always flows somewhere. Where is the aggressive capital actually finding a home this morning? Where can we see this rotation happening? This is where it gets really interesting.
We are seeing aggressive capital rotation into hard assets and geopolitical hedges immediately. The strongest sector by a wide margin is energy, integrated oil and services.
That makes perfect sense. Geopolitical volatility in South America, plus OPEC, plus holding production steady for Q1, it means energy security is the trade of the day.
Right. The market is pricing in a massive rebuilding premium for domestic and allied global producers who can quickly ramp up output to stabilize this shock.
And we can see this playing out in the gappers.
Oh yeah, you see it in the high conviction pre-market movers. First one is Cosmos Energy, KOS. It's up a massive 10% pre-market.
Why KOS specifically? That's a very targeted move.
It's a clean, fundamental arbitrage play on the supply shock. KOS just hit a massive new oil producer well in Ghana. That signals a meaningful, immediate production surge.
So reliable supply source, just as the Venezuelan supply chain goes dark.
Exactly. Right company, right moment. It's benefiting directly from the geopolitical noise.
Now, contrast that with big tech's pain. Tesla, TSLA, is down 2.6% pre-market. It's struggling to maintain its narrative.
That decline is a direct result of that confirmed, painful narrative shift. Tesla just confirmed its second straight year of declining sales, ceding the global EV crown to BYD.
And in this environment, with the cost of capital so high, testing that growth narrative is dangerous.
Very dangerous. The stock is facing heavy multiple compression because the high-yield environment exposes all of its valuation vulnerabilities.
And finally, we have the ultimate geopolitical hedge in the digital space. Marathon Digital, MARA, is running hard, up 5%.
And this is critical for understanding market psychology in 2026. Bitcoin has reclaimed that psychological $92,000 level.
Right.
It's cementing crypto's role as a primary non-sovereign geopolitical hedge. In times of U.S. military action or major instability involving traditional sovereign actors, capital flows into the decentralized asset. It's a form of global insurance.
A direct vote against traditional fiat security.
Precisely.
Okay, fascinating connections. Energy and crypto are running hard, leveraging the instability while big tech struggles. So let's get tactical. If you're focused on the open, what are the high conviction plays and their immediate levels?
We're focused on three top tickers that really capture today's narrative. First, Chevron, CVX. It's a pre-market leader, and it's positioned not just for today's price spike, but for the eventual multi-year restructuring of the Venezuelan oil industry.
What's the line in the sand for CVX today?
We are watching two structural levels. The immediate bull case level is $178. A sustained break above 175 targets the 52-week high.
Okay, a structural breakout.
Yes. And the bear case level, your primary support and gap fill, is $162.50. If crude fails to hold its highs, expect a rapid retreat back to that base.
Next up, the essential pick and shovel play. SLB, formerly Schlumberger, up nearly 10% pre-market.
SLB is purely a capex bet, capital expenditure. Investors are pricing in an immediate massive surge in upstream capex from global majors scrambling to replace that lost Venezuelan output.
So it's a bet that every major oil field in the world is about to accelerate drilling.
That's the bet. The stock is running on the expectation of future work.
So what are the key target zones?
The high side target, the bull case level, is $48.50. That was a tough resistance point, but the institutional flow we're seeing suggests a run toward that psychological $50 level.
And the downside risk.
The critical support level is $41. A failure there suggests the supply shock rally was just a knee-jerk overreaction.
Right. It means the drilling volume needed to justify the move just isn't confirmed.
Correct.
And finally, the wild card. A massive Chinese AI play that popped nearly 15% pre-market. Baidu. B-I-D-U. This seems totally disconnected from Venezuela.
It is. It's a pure value unlock narrative. BIDU rallied hard on the confirmed news of the spin-off and Hong Kong listing of its high-performance AI chip unit, Kunlunxin.
So investors are betting the sum of the parts is worth more than the whole.
Far more. They're betting Baidu plus the new separately valued chip company is a big win.
So what keeps that momentum going for BIDU against the backdrop of broader China concerns?
The momentum target, the bull case level, is $126. If that spin-off valuation exceeds expectations, BIDU could squeeze toward $130, forcing shorts to cover.
And the floor?
The hype fade floor, our bear case level, is $108. If broader China-U.S. tensions or just a simple loss of enthusiasm post-announcement overshadows the AI story, the stock will retest that December consolidation base.
Okay, we have the specific rotations. Now left pullback. What does this all mean for the broader indices? We need to define the line in the sand for the ES and NQ before the open, especially since the entire day is predicated on that 10:00 a.m. catalyst.
Precisely. That 10.00 AM ET ISM Manufacturing Index print is everything. All this pre-market positioning, all the early trading, it's all just waiting for the reaction to that data.
If it confirms cooling, the NQ might breathe a sigh of relief.
Right. But if it signals unexpected resilience, the rate narrative changes instantly, the 10Y spikes, and the indices dive.
Okay, let's define the line in the sand for the S&P 500 futures, the ES. Sources show it pivoting right around the 6,900 handle this morning.
On the resistance side, we have resistance 1 at 6,915. That's the immediate intraday ceiling. And the true hurdle is resistance 2 at 6,938. That's the big wall. If we break that, the door's open to hunt for 7,000.
And the risk profile we need to be watching.
The crucial line in the sand support is 6,882. The bulls absolutely must hold that level.
And if they don't?
If 6,882 is lost, the risk zone opens up immediately at 6,855. A break below that signals a major fail at the top situation. It confirms the recent move higher was unsupported, and it likely triggers a multi-day slide.
Moving to the Nasdaq 100 futures, the NQ. We know it's much more vulnerable to that high valuation headwind if the 10-year breaks higher.
The NQ is dancing right around its all-time highs. So resistance 1 is the 2025 high at 25,180. That is the immediate ceiling. A clean break there would suggest the market is ignoring the rate risk for now.
And the critical support we need to watch today, the level that tells us if that duration risk is finally sinking in.
The critical support, the line in the sand, is 24,850. The NQ must hold this on a closing basis to keep the structural bull case alive.
And if we lose that level?
If we lose that level, the risk zone opens up at 24,600. And if 24,600 is lost, the AI fatigue narrative takes over. It confirms the consensus that tech is simply too expensive for this current interest rate environment.
That is the clear signal. Okay, we have the macro drivers, the aggressive sector rotation, and the tactical levels locked in. What's the final trading directive for the listener today as we head toward the open?
The bottom line is this. Today is about observation, analysis, and confirmation. Not heroics.
Don't be a hero.
Do not be a hero. You absolutely must avoid chasing the 9:30 a.m. implied open. The market is coiled, and that 10.00 a.m. ISM data is the real starting gun. Wait for that data and the market's reaction.
So wait for confirmation. Distill the play summary for us.
Simple. If the S&P 500 holds 6,882 through the data, you look for a grind toward the 6,915 targets. But if the Nasdaq fails 24,850 post-ISM, the valuation narrative is confirmed, and you need to be positioned for that defensive energy and hard asset rotation.
This volatility is completely dominated by the energy supply shock right now. And that leads us to our final provocative thought for you to consider as you watch the screen today. We know energy is the current driver because of Venezuela. But what's the single biggest risk that comes with a surging energy market that the market seems to be ignoring right now?
The resurgence of supply-side inflation.
Exactly. If energy rallies violently today, how does that supply-side inflation shock impact the market's current assumption for a generous March rate cut? The market is positioned for Goldilocks. It's betting the Fed is done fighting inflation. But if crude keeps climbing aggressively because of this disruption, is the soft landing already off the table before January is even done?
That's the question that will truly define Q1. Stay nimble.